Welcome back to Investing Talk Podcast.
Great to be back.
Today we are tackling, well, one of the absolute hottest, most volatile stocks out there. We're asking that big question everyone's wondering, is Amprius Technologies a good time to buy right now?
It's the question, isn't it? Because Amprius, they're right at the cutting edge of battery tech.
Yeah, they're leading the charge with these next-gen silicon anode lithium-ion batteries. Super important stuff for like advanced planes and drones.
Absolutely crucial for those applications. And the stock's movement, well, it's been incredible. Dizzying, really. So we need to dig in and see if the fundamentals actually support that kind of excitement.
Exactly. So our goal today for you listening is basically to give you the lowdown on the investment case here. We'll look at the recent momentum, the financials, that tech advantage they have, and importantly, the risks. And we're sticking only to the info we've gathered from our sources. Oh, and before we dive in, please hit that subscribe button, give us a like, and definitely leave a comment below. Let us know if there's a specific company you want us to analyze in a future show. Just drop the name in the comments.
Yeah, definitely do that.
Yeah.
So just to frame this, you're looking at a company that's seen, well, extreme volatility. Our job here is to unpack the recent news, the financial structure, its competitive edge, and the potential bumps in the road, just so you get a clearer picture of what you'd be buying into.
Okay, let's get right into it. Section 1. That rocket ride, the recent momentum, and the validation behind it. The price action alone is something else.
It really is.
Looking back 12 months, Amprius is up around 883%. That's almost hard to comprehend. Hypergrowth doesn't even quite cover it.
No, it doesn't. And that huge jump tells you there's been a major shift in how the market sees this company. The price closed recently at $12.78. That was October 17th.
Right near the top of its range.
Exactly. Its 52-week range is massive, from $0.18 up to $16.03. And, gaining another 40% in just the last month after already running up so much. That takes more than just hype. You need real proof points.
And the sources show those proof points did land, especially back in September 2025. What was the big one? What really cemented this latest surge?
I think the key catalyst was that repeat purchase order, a big one. $35 million from a major aviation customer.
Repeat order. That's significant.
Hugely significant. It shifts the story from, cool R&D project to actual commercial adoption. An order that size, especially a repeat one, basically confirms their battery platforms, the Sikor and Cymax, are actually delivering in the real world, meeting those tough performance specs.
So that must have really changed the conversation, moving beyond the science project phase, like you said. How did the analysts react?
Well, it definitely got their attention, caused a wave of new coverage. Before that order, there was some skepticism. But afterward, recommendations really started lining up behind a strong buy consensus. And they made a strategic move, too. Appointing Ricardo C. Rodriguez as the new chief financial officer in October, that's a signal.
What kind of signal?
It suggests management is shifting gears, moving beyond just the tech focus and really prioritizing solid financial management, getting ready to scale efficiently, thinking about margins. That's exactly what you want to see when a company hits this rapid growth phase.
And you can already see that growth hitting the books, right? Trailing 12-month revenue growth, a stunning 166.95%.
Yeah, it's remarkable. It really shows they're gaining traction in those high-value areas, aviation defense applications.
Okay, so that growth is impressive, which naturally leads us to Section 2, the fundamentals. Let's talk about that tech advantage versus the current lack of profit.
Right. The moat versus the margins, as we're calling it. We need to figure out why this company has such a premium valuation when it's, well, not profitable yet.
Let's start with the moat then. Silicon anode batteries. Can you break down for the listener why this tech, the Sikor and Cymax stuff, is such a big deal? Why isn't it just another slightly better battery?
Okay, this is really the heart of the investment case. Amprius genuinely has a first-mover advantage in getting these silicon anode lithium-ion batteries to market commercially.
And why silicon anode?
Because in areas like aviation, traditional lithium-ion batteries just hit limits. They're too heavy, too bulky for the power they provide. Amprius's tech unlocks way superior energy density.
Meaning more power in the same space or weight?
Exactly. More energy packed into the same pound or the same cubic inch. For a drone or electric aircraft, that directly translates into much longer flight times or carrying heavier sensors or, both. It's not just a small improvement, it's a performance multiplier.
Oh, okay, I see. That justifies a higher price, presumably.
It does. And it creates a real barrier for competitors still using older graphite-based tech. Their intellectual property, their early customer wins.
Mm.
They're sort of locking up that high-end aviation market early.
So the tech is clearly disruptive. But here's the rub, the paradox you find with so many disruptive tech investments. Current financials. You mentioned that spectacular revenue growth, 166.95% year over year. But they're still deep in investment mode. What do the losses look like?
Yeah, we have to be really clear here. This is absolutely a grow now, profit later story.
Right.
Amprius posted a net loss of $45.4 million in 2024. And that loss actually grew up 23.4% from the year before.
Okay. And cash flow?
Negative, as you'd expect.
Yeah.
Free cash flow was around negative $51.35 million in 2024. It just reinforces that strategy to pour money into growth.
So where's that $45 million plus loss actually going? Is it just operational costs or is it strategic spending? What do the sources say?
The analysis points overwhelmingly to strategic investment. Yes, there's R&D spending to stay ahead technologically, but the big chunk is going towards scaling up production capacity, building out factories.
The factory build-outs.
Exactly. They're spending fast and heavy to make sure they can meet the kind of demand shown by that $35 million order. They need to capture that market share before competitors can catch up.
Which makes the balance sheet absolutely critical. They need enough cash to survive this burn rate until they reach scale. How are they looking financially in terms of resilience?
Surprisingly strong, actually, considering those losses. The company has a healthy cash position and, crucially, very little debt.
Okay, low debt is good.
It's key. That financial flexibility is what lets them handle a $51 million negative cash flow without hitting the panic button. They've got breathing room, runway, the market, the analysts. They all understand this spending phase. That's why projections focus on the future, not current earnings.
And what are those projections saying?
Analysts are currently forecasting a turn to positive free cash flow, but not until 2027. The bet is that once these big new factories are up and running efficiently, the higher margins from their proprietary tech will kick in and generate significant profits.
So it's really all riding on executing that scale up perfectly and on time. Okay, let's shift gears. Section 3, near-term catalysts and the technical picture. If you're maybe a shorter-term trader looking at Amprius, what's the main thing to watch right now?
One word. Earnings.
Right. The Q3 earnings release coming up on November 6, 2025. Given the stock's run and that big order, expectations must be sky high.
Astronomical. The consensus is looking for continued really high double-digit, maybe even triple-digit revenue growth. Anything less than a strong beat or maybe a big guidance raise could be punished pretty hard by the market.
Definitely a key event.
Yeah.
What else is on the short-term radar? Any market mechanics?
Yeah, a couple of things to keep an eye on. There's the ETF rebalancing window around November 29th.
Mm-hmm.
If Amprius gets added to some specialized tech or clean energy ETFs, which there's some chatter about, that could mean forced buying from those funds.
Providing some support for the price.
Could do, yeah. And then you've got the institutional ownership filings due around January 5th, 2026. That'll show us if the big money, the major institutions, have been building positions quietly. That's always a strong signal of conviction.
We've also heard some rumors, speculation that could really move the stock if it pans out. What's the buzz?
The main speculation seems to circle around two potentially big developments. First, maybe an announcement of strategic partnerships with some major aerospace or defense players.
Formalizing those relationships.
Exactly. Turning those purchase orders into official long-term deals would significantly de-risk their future revenue. Second, and maybe even more critical given the execution risk we talked about, are rumors about an upcoming announcement on a new factory.
Ah, the new factory again. That would directly address the scaling concern, wouldn't it?
Absolutely. If they announce a concrete, well-funded plan for a major expansion, it tells the market they have the capital and the plan to actually build the capacity needed to meet that future demand. It would be a big confidence booster.
Okay, let's look at the chart itself for a second. The technicals look pretty strong, right?
Zigging bullish, really. The price is comfortably above both its key moving averages, the 50-day simple moving average, which is around $9.52, and the longer-term 200-day SMA, down at $5.07. That confirms the underlying trend is still very much upward.
And any other indicators worth noting?
Well, if you look at the 14-day Relative Strength Index, the RSI, it's currently sitting around 37.3.
Which means, for listeners, what does that tell us?
So RSI measures momentum. Over 70 is usually considered overbought, under 30 oversold. At 37.3, it suggests The stock has actually cooled off a bit from its recent tear. It's not in that overheated zone. Technically speaking, there's room for it to move higher without hitting those immediate overbought warnings.
And analysts seem to agree there's more upside, even after the huge run.
Very much so. You've got a solid consensus, 6 to 9 Wall Street analysts covering it mostly with strong buy or moderate buy ratings. Their average 12-month price targets fall in a range from about $13.14 up to $15.27.
Okay, so implying some upside from the current $12.78.
Right. And the most optimistic high-end target out there actually goes up to $20. That suggests some analysts see potential for, maybe another 20% gain from recent levels. They still believe it's undervalued relative to the tech advantage.
Okay, this all sounds very positive, but we need to inject some realism. Section 4. Risks and the final thesis. We know the tech is exciting, the growth is there, but this is definitely not a sure thing. What are the main dangers investors need to consider?
Number one has to be valuation risk. Let's be blunt. The current price is high. That $12.78 share price, the overall market cap, it already assumes a lot of future success. It assumes rapid scaling happens smoothly, execution is near perfect.
So you're paying today for tomorrow's results, essentially.
Pretty much. Which means any negative surprise earnings disappoint, a competitor makes a leap, there's a delay building that new factory could cause a really sharp drop in the stock price, disproportionately sharp.
And that ties right into the second big risk, execution risk.
Exactly. Building these advanced custom manufacturing lines on time, on budget, it's hard. It's notoriously difficult in high tech. Any major hiccups, cost overruns, delays in getting those factories online, that pushes back the timeline for profitability and the valuation will take a hit. They have to nail the scale up.
Makes sense. Any other major risks?
I'd point to market volatility. This stock has a high beta, 2.87.
Remind us what beta means.
Beta measures how much a stock tends to move relative to the overall market, like the S&P 500. A beta of 1 means it moves in line with the market. A beta of nearly 3, like Amprius has, means that the market drops 1%. This stock, historically, might drop almost 3%.
Wow. So it really amplifies market moves.
It does. It makes it very sensitive to broader economic worries or downturns in the tech sector. If the market catches a cold, the stock could get pneumonia.
Okay, so putting it all together, amazing growth, game-changing tech, real customer demand, but also a hefty price tag, significant execution hurdles, and high sensitivity to market swings. What's the final investment thesis distilled from the sources? What's the overall rating?
The consensus view lands on an overall bullish rating of 8.5 out of 10. The summary is something like, strong upside potential, but with high risk, though maybe not reckless risk.
High, but not reckless. Why that distinction?
Because the reasoning is that the technological moat, especially in those high-value aviation markets, is just so strong, and the customer traction is now proven. That combination is seen as compelling enough to justify taking on that short-term negative cash flow and execution risk, provided management delivers on those expansion plans.
So it sounds like a stock that could appeal to different types of investors for different reasons.
I think that's right. It looks quite attractive for, say, short-term traders who want to play the upcoming catalysts, the Q3 earnings, potential partnership news over the next maybe 1-3 months.
And then also for the patient long-term holder.
Absolutely. Maybe even more so for the long-term investor. If you believe in the multi-year story of electrifying aviation, of global decarbonization trends, this high-density battery tech is almost essential. So for someone with a 3 to 5 year horizon, it's a bet on capturing that huge sector-defining growth.
It really is a fascinating case study. To really get a handle on this stock, you, the listener, have to weigh that incredible top-line growth against the very real current losses and that huge execution challenge.
Yeah, it's that classic dynamic. You're essentially buying the potential of the future, not the reality of the present earnings.
Which brings us to our final thought for you to chew on. Looking ahead, assuming Amprius does successfully build out its manufacturing capacity like everyone expects, maybe the biggest question isn't just about keeping up growth in aviation. Maybe it's about which other massive global industry gets unlocked next by licensing this silicon anode tech. Could the ultimate prize be the entire electric vehicle market? And if so, what's that potential worth in today's stock price?
That is indeed a multi-billion-dollar question.
Something to think about. Well, thank you for joining us for this analysis today. We hope going through the source material like this helps you understand the landscape for Amprius Technologies a bit better. We'll see you next time on Investing Talk Podcast.